Welcome to the deep dive. Today we're tackling a really, an incredible number that's floating around serious finance circles.
Yeah, Bitcoin price hitting somewhere between $200,000 and $240,000.
Exactly. Sounds almost like fantasy, right? So is this just hype, or is there, a solid argument behind it?
That's the mission today.
Right.
We're not here to pump anything. We want to unpack the logic. Is it grounded in real analysis?
Right. We'll look at the technicals, the sort of macroeconomic picture, and recent trading stuff to see if it all lines up.
We're connecting three pieces: historical patterns, U.S. economic health, and what the charts are doing right now.
Think of it like building a case. You need the plan, the power, and the green light.
Absolutely. Let's start with that plan, the big technical pattern pointing towards those huge numbers.
Okay, the blueprint. It leans heavily on something called Elliott Wave theory.
Dates back to the 30s, believe it or not.
Yeah, and the basic idea is markets don't move straight up or down. They move in these wave-like steps, typically 5 steps in a big trend.
That's the gist. Wave 1 is the first push-up. Then wave 2 is this pullback, a correction. It's really important tests conviction.
A shakeout, kind of.
Exactly. And if it holds, then you get wave 3.
And wave 3, that's the main event for this whole scenario.
Oh, yeah. It's often described as the longest, the strongest, the most explosive wave. It's where, mass adoption can kick in, belief spreads, and prices can really take off.
Parabolic is the word people use.
Often, yes. So the big question is, where are we now in that cycle?
And one analyst, Gert Lagen, thinks we're right at the Launchpad.
He argues we've just finished that corrective wave 2.
Yeah.
He's looking at the weekly chart, so the really big picture view.
And the key signal for him.
It's how the price recently touched and then bounced hard off the 40-week simple moving average.
Okay, 40-week SMA. Sounds technical. Why is that specific average so important?
Well, think of it like the average price over roughly the last 10 months. When price hits that line from above and jumps back up strongly.
It means buyers are stewing in.
Big time. It suggests the market, on average, sees value there and is defending that level. Van Lagen calls it a solid floor, or even a spring mattress.
A spring mattress, I like that.
Yeah, because historically, strong bounces off this 40-week line have often preceded Bitcoin's most powerful moves. It signals the correction might be done.
So he sees it as stair steps. Move up, wave 1. Build a landing, wave 2, like we saw in 2019 and 2023, and now potentially leap to the next step.
That's the model, and based on how big these wave 3s can get relative to the earlier waves.
That's where he gets the $200,000 to $240,000 target.
That's his projection for this next potential leg up, yes.
Okay, that's one view. But you mentioned another analyst, Jelle.
Right. Jelle uses a different tool, but comes to a similar bullish conclusion long-term. He looks at what's called the long-term rising price channel.
Bitcoin's moving up a road with curbs on either side.
Pretty much, yeah. An upward sloping road. And right now...
He says Bitcoin's hitting resistance, like a barrier in the middle of the road.
Exactly. The median line or the divider. It's been a tough spot to break through recently.
But if it breaks...
Then Jelle's analysis suggests the path is clear to the top edge of that road, the upper curb.
And that target is?
Based on that channel's projection, it could be even higher. He calculates it somewhere near $350,000.
Wow. Okay, hang on. Elliott Wave from the 1930s. Does this stuff really apply to something as, new as Bitcoin? Railroads and utilities back then, now digital code?
That's a fair question, a really important one. The confidence isn't necessarily in the asset type, it's in the human psychology driving the price.
Ah, so the emotions are the same. Fear, greed, doubt, conviction.
Precisely. Those patterns of collective human behavior moving from early enthusiasm to doubt, then to mass belief, they seem to repeat. Bitcoin might just be drawing that pattern much, much faster.
But still, these are just lines on a chart. You need fuel. You need serious money to make those kinds of moves happen.
Absolutely. Which brings us perfectly to the next piece. Where does potentially hundreds of billions in new capital come from?
Okay, so let's talk fuel. This involves looking away from Bitcoin charts.
Completely. We turn to researcher Sminston With, who's focused purely on the U.S. economy and global money flows.
And the key metric here is the PMI, the Purchasing Managers Index.
Yep. Simple survey basically asks factory and service managers, are things expanding or contracting? Above 50 is growth, below 50 is weakness.
And the data Sminston With highlighted is pretty shocking.
It really is. The U.S. PMI has been below 50, meaning in contraction or weak growth territory, for nearly 3 years straight.
3 years? That seems long.
It's incredibly long. Sources identify this as the longest period of sustained economic weakness recorded since 1948.
Since 1948? Wow, okay.
Puts things in perspective, doesn't it? It's a massive historical anomaly.
So what's the implication? Smithston With uses an analogy, right?
Yeah, the compressed spring. The idea is the economy has been pushed down, compressed for an unusually long time.
And springs, they snap back.
Eventually, yes. History suggests this kind of prolonged compression leads to an almost inevitable, often powerful, rebound. A reversion to the mean. Things don't stay suppressed forever.
Okay, so the economy snaps back. How does that fuel Bitcoin?
Well, when that recovery happens, confidence returns. Businesses invest, people spend. The whole mood shifts. Capital stops hiding in safe assets like cash or low-yield bonds.
Because suddenly there's less fear, more opportunity.
Exactly. Investors get impatient for returns. They start looking for growth, for higher potential returns, even if it means more volatility. This creates a risk-on environment.
And Bitcoin is definitely seen as a high growth, high volatility.
Risk asset, exactly. So large amounts of capital could flow out of safety and into assets like Bitcoin, seeking those outsized returns during the economic rebound.
So the macro picture is basically setting up this huge potential tailwind.
Or maybe even a tidal wave of liquidity and optimism. It's the potential fuel needed to power that massive technical wave 3 structure we talked about.
The technicals provide the path, the macro provides the push.
That's the argument, yes. A historical economic snapback could provide the necessary conditions.
All right, so we've got the long-term technical map and the potential macro engine. But what's happening like right now? Do the short-term signals support this bullish idea? Is the market actually getting ready?
Yeah, that's crucial. And the recent data does suggest the market's been going through a kind of necessary cleanup, maybe preparing for a healthier move.
Cleanup. What does that look like?
Well, one thing is CME gap filling.
Yes, the Chicago Mercantile Exchange futures. They close on weekends, right? And sometimes reopen Monday, way higher or lower, leaving a gap on the chart.
Exactly. And there's this tendency, almost a tradition in trading, for price to eventually come back and fill that gap.
Why, though? Is it like a rule?
Not a hard rule, no. It's more psychological. The gap represents a price range where no trading happened, maybe some uncertainty or inefficiency. Markets often seem drawn back to those levels to sort of resolve them.
Okay, so did Bitcoin do that recently?
It did. Sources confirmed it returned to fill a key CME gap from a weekend move. And now it seems to be trying to build a new floor, a base, just above $105,000.
Trying to find solid ground. That sounds healthy.
It's generally seen as constructive action, yeah. Consolidating after filling the gap, trying to establish support before potentially moving higher.
Okay, what else? What about who's actually trading?
That's interesting, too. The derivatives market seems to have cooled off quite a bit.
How do we know?
Well, futures open interest, that's the total number of active futures contracts, dropped sharply after a big liquidation event around October 10th.
Meaning fewer big bets are being placed, less speculation.
Less speculative heat, potentially. And complementing that, data from CryptoQuant shows the average size of futures trades has also fallen significantly.
Right, average trade size down. What does that tell us?
It suggests the whales, the really big investors making huge bets, might be sitting on the sidelines for a bit.
Waiting. So the market's being driven more by smaller players right now.
Seems like it. Mostly smaller, perhaps retail transactions driving things currently.
And why is that considered a good sign for a potential rally? Fewer big players sounds counterintuitive.
Because it can mean less large-scale selling pressure lurking just overhead. Whale trades, especially leveraged ones, can cause huge, sudden dumps.
So removing some of that instability makes the foundation stronger.
Potentially, yes. It allows a recovery to build more organically without being immediately slammed by massive sell orders from nervous or over-leveraged giants. The intense selling pressure might have eased off.
Okay, that makes sense. And this ties into liquidations too, the washing out the weak hands idea.
Exactly. Data from High Block Capital showed big clusters of long positions, people betting on price increases. Often with borrowed money got liquidated near $100,000 on November 4th and 7th.
So the overly optimistic, highly leveraged folks got wiped out.
Pretty much. The market swept out some of that fragile capital.
And what happened right after those liquidations?
Crucially, the price didn't just collapse further. It actually recovered slightly, almost immediately after those forced sales finished.
Showing there's underlying buying interest waiting.
It suggests that yes, stronger hands, perhaps less leveraged buyers, are stepping in once the forced selling pressure from the liquidations is gone.
So putting it all together, the market filled gaps cooled down the hot money, shook out the leveraged players, and is now trying to build that base above 105K.
That's the short-term picture. It looks like a necessary consolidation and cleanup, potentially laying the groundwork that aligns with those bigger bullish calls.
Okay, this is quite a compelling narrative. The long-term chart pattern, the massive economic pressure cooker, the recent market cleanup, it all seems to point upwards.
It's a strong logical case based on the data presented by these analysts.
But we absolutely have to stress, this is analysis. It's based on past patterns, current data, economic models. It is not financial advice. Nothing is guaranteed in markets.
Couldn't agree more. So the key question is, what should you, the listener, take away from all this? How do you apply this knowledge?
Right. Takeaway number one seems to be about perspective.
Absolutely. Develop long-term vision. Remember, this entire analysis, the weekly charts, the multi-year economic cycles, this is a long game.
This isn't about next week's price.
Not at all. This requires patience. You can use this understanding, this framework, to maybe steel yourself against the inevitable short-term bumps and dips. Don't get shaken out by noise if you believe the long-term signal.
Which leads straight into the next point. Those bumps could be huge.
Oh, yes. You must assess your risk tolerance. Seriously, if these analysts are right about a wave 3, the path to 200K or 350K will likely be incredibly volatile.
We're talking big swings.
The sources suggest drops of 30% or more within that overall uptrend are entirely possible, even expected. They happened in previous parabolic moves.
So the gut check question is, can you actually handle seeing your investment drop by a third, maybe in a week, and not panic sell?
That's the question. That volatility is the price of admission for potentially capturing those huge gains. You need to know your limits before you're in the heat of the moment. Plan when your head is cool.
Okay, sound advice. What else?
Encourage critical thinking. Please, don't just blindly trust us, or Van Lagen, or Jelle, or Sminston with.
Use this as a starting point.
Exactly. Use these names, these concepts, Elliott Wave, 40-week SMA, PMI data, channel analysis, as tools for your own research. Dig deeper. Challenge the assumptions. See if it makes sense to you.
It's about building your own conviction, not borrowing someone else's.
Perfectly put. And finally, if you do decide this outlook aligns with your views and risk tolerance, formulate a strategy.
Not just if you'll buy, but how.
Right. How will you enter? Maybe dollar cost averaging to smooth out entry points? And maybe even more importantly, where are your potential exit points?
Your profit targets.
Yes. You need to decide those targets before the potential surge happens. If Bitcoin is suddenly screaming towards $200 and everyone's euphoric, that's the worst time to try and make rational sell decisions. Emotion takes over.
Strategy helps keep emotion in check. Plan your trade, trade your plan. Hashtag tag outro.
So to recap, we've explored this powerful potential convergence. You have the Wave 3 technical structure calling for a massive expansion.
Fueled potentially by the compressed spring of the U.S. economy, snapping back after a historically long period of weakness.
And underpinned, at least recently, by short-term market action, showing consolidation and cleanup above that key $105,000 level.
It paints a very logical, very optimistic, albeit long-term picture based on these analyses.
It really does.
Which leaves us with a final thought for you to consider. We talked about how this multi-year economic compression shown by that PMI data could create a huge risk-on wave, potentially launching Bitcoin.
Right.
While that economic spring does snap back violently and trillions in capital do flood out of safe havens looking for returns, what other asset classes, maybe even other corners of the crypto market or completely different sectors, might experience their own historically unprecedented moves in that kind of environment?
That's a fascinating question. What else gets lifted by that massive tide?
Something to chew on.
Definitely. Thank you for joining us on this deep dive. We hope breaking down these different layers, the technical, the macro, the short term, gives you a much clearer framework for understanding why these, frankly, mind-blowing Bitcoin targets are being seriously discussed.
Hope it was useful.
We'll catch you on the next one.